The ideal portfolio using individual stocks. What is that? What can you expect to get out of this video presentation? When you're done watching this video, you'll be able to explain why each investment is in your portfolio and its role. Anyone worth their salt as a money manager should be able to tell you this as well. In this video, I'm going to cover how you can create a portfolio using individual stocks for the risk portion and ETFs for the safety portion. Although, you can just as effectively buy individual treasuries for the safety portion. Both work equally well. And if you're like Calvin, that's too much, that makes my brain hurt. Well, you can learn how to create this portfolio using just 2 to 3 ETFs. Watch my video titled, The Ideal Portfolio Using Just 2 ETFs or Mutual Funds. Link in the pinned comments below. The ideal portfolio isn't one portfolio for everybody, but they're similar. But it'll be influenced by the risk tolerance and the investment goals of each investor. But as a money manager for many clients, I'll tell you what works well for my clients is to balance their desire for return or growth versus their ability to tolerate losses. And as anyone knows who has lived through the dot-com bubble crash in 2000, the financial crisis in 2008, the pandemic in 2020, and the more recent unbelievable and unprecedented interest rate increases by our Federal Reserve in 2022, losses, and big ones, will inevitably happen. Before we get into the details of portfolio design, the most important piece of advice I'm going to give you in this video, or in any of my videos for that matter, is this. To succeed as an investor, you must take the long view and hold on to your allocations no matter what the market conditions, and dollar cost average into your investment accounts over time during good and bad markets. I guess that's a mouthful way of saying don't try and time the markets. Look, if you think you can save yourself by selling your portfolio holdings when your portfolio is at a loss, and trust me, you will be tempted, more than tempted, and then be genius enough to get back in before the market has recovered, you're sorely mistaken. The biggest mistake you can make as an investor is to sell your risk holdings when your portfolio is down a significant amount. If you really want to call yourself an investor, then you'll be investing in the businesses and the people running them. You're not investing in the current stock price, the current valuation, the PE ratio, or the current market conditions. There is a huge difference between doing those things and being an investor. If you have any doubts about the advice I'm giving you, I'll put a link in the comments below to a YouTube short video titled, The Biggest Investment Mistake You're Tempted to Make Right Now. I'll also put a link to a blog article I wrote that discusses the damage caused when investors become afraid and sell their losses at or near the bottom. Also linked in the comments below. But let's get back to portfolio design. I like to use the design of a pyramid for the design of a portfolio, mainly because it's very easy to visualize and see what's going on. The details and proportions of the pyramid segments will depend on your desire for growth versus your tolerance for losses and risk. There are 3 sections of the portfolio, and therefore 3 sections in the pyramid. First and most importantly, there's a base section of the pyramid where we're going to put our safe haven assets. So these will be U.S. government treasuries and cash, or instead of cash, you could think money markets or T-bills. Very safe investments. Second, there's a middle section that consists of stable growth stocks. Usually these stocks find themselves in consumer staples in that sector, and you'll see why we're including those when I show you how the portfolio performs. And then finally, the top and smallest section of the pyramid consists of very high growth stocks, typically these days in technology, but who knows if this will hold going forward. And don't expect to find value stocks in this peak of the pyramid. These are going to be high growth stocks. They might turn into value stocks later, but when you're buying them, they are not going to be selling for a value. Look, from my experience, most people, whether they realize it or not, want a strong base that is safe and can support the rest of the portfolio structure during bad times. And return is not your main objective in the safety portion of your portfolio. Safety is your main objective. It's a huge mistake to reach for return in the safety portion of your portfolio, because reaching for return means taking more risk. This safe haven portion of your portfolio should be invested in U.S. government treasuries, and it'll become obvious later when I show you the nonlinear effect they have on your portfolio performance. Using government treasuries will maximize your returns and minimize your maximum losses. Okay, that's a little confusing, but I think you get what I'm talking about. If you're a super aggressive investor with a high tolerance for volatility and losses, yeah, I'm talking to you. I caution you not to leave the stable base off and shoot for the moon. You won't be protected in the case where there's a catastrophic loss due to an unforeseen event. You could lose most or all of your portfolio very quickly in a situation like that. Don't be that guy. Oh no, I lost 95% of my portfolio. Now what should I do? While we haven't seen a situation like that yet, it could and most likely will happen at some point in the future. The reason I bring this up is because most investors become extremely afraid and distraught when facing these kinds of severe losses. And what do? They sell their holdings at or near the bottom. And look, I'll tell you, selling your holdings at or near the bottom locks in your losses. Why? Because it puts them in cash with no potential upside. Then as the markets recover, as they always do, you get left behind. Think about it. Then to make matters worse, the assets don't get reinvested until well past the bottom, and this causes the portfolio to take many years, if not a decade or more, just to recover to its previous high water mark. Look, you work really hard for your money and it's difficult to save, so don't put yourself in a position where you lose a lot of money and then lock in your losses. That will not put you in a good place. I don't want to see that happen to you. Now that we've discussed how important that base of safety is in portfolio construction, let's talk about how to optimize the risk asset or equity side of your portfolio. And before we jump into that, I'm also going to show you sort of the typical proportions for each one of these sections. And I'll show you how that works when I model out some of these portfolios. This middle section should be somewhat stable, but with good growth prospects. And the top section should be exposed to high growth companies with high return prospects. The reason this structure works for most investors is because it provides unlimited upside via the risk portion with limited downside via the safety portion, or as Nassim Nicholas Taleb describes it, Antifragile in his book titled Antifragile, Things That Gain from Disorder. You're welcome, Nassim. You can create this type of portfolio with mutual funds, ETFs, individual stocks, or with a combination of all of them. Contrary to popular belief, using ETFs for this type of portfolio is not difficult to do, and it's definitely not rocket science. But if you're going to use individual stocks, you're going to have to do a lot of work and a lot of analysis and a lot of reading and a lot of thinking. So how many stocks do you need in your portfolio?
Hey, I got a confession.
Well, I'm going to publish another video that goes into the details of how many individual stocks are required to create a constructively diversified equity portfolio. You notice I use that word constructively diversified because you don't want to over-diversify your portfolio. It will actually hurt you, not help you. But the short answer of how many stocks you need in your portfolio is surprisingly few stocks. 10 to 15 are more than enough to implement a successful portfolio. And you can see that in this experiment I did here, and I'll explain this in a future video where I talk about the minimum number of stocks to have an effective portfolio. So what you're looking at here on this vertical axis is compound annual growth rate, and it's supposed to be standard deviation of the portfolio, but this is mislabeled. And then on the horizontal axis, we're looking at the number of stocks in the portfolio. So let's take a look at the median compound annual growth rate here. I did this across 10 random portfolios. And you can see that the return, the compound annual growth rate, wobbled around here at the beginning, but then as you start to add more and more stocks to your portfolio, it stabilizes, and it gets pretty stable around 9 or 10 stocks. And then if you keep going, it drops off a little bit. The return drops a little bit by the time you get to 15 stocks. And then if you keep adding more stocks, 20, 30, 40, 50 stocks, you see the return doesn't improve. And what are these orange triangles? Well, the orange triangles are the average standard deviation of the returns of the portfolios. And you can see for one stock, obviously, the standard deviation is huge. And then as we add more stocks, the standard deviation comes down, kind of reaches a sort of a minimum here and levels out. And really, again, doesn't change much as you add more and more and more stocks. Now, this next number is going to kind of boggle your mind a little bit. It's a very complex looking equation, but basically think of it as risk-adjusted return. So if you look at these blue dots, you can see that they peak out right here at about 11 stocks in the portfolio. This is sort of a sweet spot, and then they fall off out here. So somewhere in here in this 9 stock to 15 stock portfolio, you're about at optimum. You don't need more stocks than 15 stocks. In fact, it's kind of counterintuitive, but if you add more and more equities to your portfolio, you actually end up stifling your ability to get better returns, and you don't get any additional protection from losses. That doesn't sound very good or very bright, does it? Look, do yourself a favor and don't listen to the common wisdoms when it comes to investments. You know, and we've all heard them, things like rebalance often. No one ever got hurt by taking profits. And diversify, diversify, diversify. These great wisdoms are thrown around to make you think the people saying them actually understand what they mean and how they'll affect your portfolio performance. But I've got news for you, they don't. If you need proof, just watch my video titled, Why Most Money Managers and Retail Investors Will Never Beat the S&P 500, or my other video, Stop Investing in the S&P 500 Now. Links in the pinned comments below. As I mentioned earlier, if you're interested in building a portfolio of individual stocks, then be prepared to do a ton of research for each company you evaluate, even if you get ideas from the very few great analysts out there like Kathy Wood and her team at ARK Invest, or some of the top-ranked analysts on tipranks.com. Otherwise, stick with some of the simple ETF portfolios I describe in my other video link below. Once you select and purchase a business, you notice I didn't say stock, in your portfolio, hold it until you don't believe in the business anymore. Don't sell it just because it has gone up or down. Be an investor, not a trader. The portfolio I'm showing you here consists of a base of safety assets held in U.S. government treasuries. Now again, these can be held using ETFs, like what I've done here with the ETF TLT, or by purchasing treasuries. And as I said earlier, the risk portion is broken up into 2 pieces. The larger piece is held in what I like to call stable growth companies that are typically viewed as consumer staples. Now look, some examples are Procter & Gamble, Coke, Pepsi, Johnson & Johnson, McDonald's, etc. I can keep going on, and you'll know all the names. They've been around for a long time. You need their products to live your life. So they're very stable in terms of stock performance. And you can see those stocks listed here at the bottom of this table. These stable growth companies should be about 65% of your risk assets. So if your risk exposure is 60% of your portfolio, these stable growth companies would account for about 39% of your total portfolio, or 0.65 times 0.6, which equals 0.39. The smaller part of the risk portion is held in growth companies. Now, going back 15 to 20 years, these would have been companies like Amazon, Apple, Intel, Microsoft, and Adobe, and you might have picked somebody like Dell along the way, or God forbid, Digital Equipment Corporation. And these stocks are shown right here in the orange. You can see them right here. Now, look, along the way, you might have replaced these, like, for example, replaced Intel with NVIDIA, or one of the other holdings with Netflix, Tesla, or Google. But the important thing here is to hold about 35% of your risk exposure in these high growth companies. So again, if your risk exposure is 60% of your portfolio, these high growth companies should be about 35% of your risk assets, or 0.35 times 0.6, which equals 0.21, or 21% of your entire portfolio. And please do yourself a favor and forget about buying these companies when the analysts consider them cheap. By the time they generate enough earnings to be considered a value play, most of the growth has already taken place. And I'll share a perfect example of this with you: Warren Buffett's investment in Apple. He missed out on at least 48 times his investment instead of the 7 times he actually got, because he waited for Apple to become cheap. For more on this fallacy of using value to decide when to buy stocks, watch my video titled, "Should Warren Buy Tesla? A Question of Value?" Link in the pinned comments below. Before we take a look at how a portfolio constructed this way would have performed, the graph you're looking at shows return or loss down here, return up here, compound annual growth rate or compound annual loss on the vertical axis, and the horizontal axis shows you the maximum loss you would have incurred over the time period, in this case 20 years. So 0% loss all the way to 100% loss of your portfolio. So basically think of it this way: anything up here and to the left is good, and anything down here and to the right is very bad. Look, I know we're using survivor bias and future knowledge here, and your actual results going forward will differ from what I'm about to show you. Your returns will most likely be worse. They could be, but they could also end up being better if you pick the right companies for your investments and the overall market conditions are favorable. No one knows what the next 10 or 20 years will bring. So what do we have here? Well, as I said, we've got the pyramid going on. We've got 40% of our assets in safe haven assets. These are U.S. government long bonds, treasuries. And then you can see all of these other little bubbles. These are the companies listed over here in this table. Now let's zoom into this graph and take a look. So what we're looking at here is a portfolio where I've allocated 60% of my portfolio to risk assets and 40% to safe haven assets. So you can see here the safe haven assets in this particular case consists of government long bonds, TLT, the ETF TLT. We have 40% of our money there. And you can see that we've got all these little bubbles here. These are the 15 stocks, and 10 of them are more consumer discretionary oriented, although not all of them. And then 5 of them are what would have been considered growth stocks back in the day, a long time ago. So let's take a look. So this cluster down here, now you can see this cluster down here doesn't have really high returns, but it also doesn't have as high losses as, for example, the S&P 500, which lost 55% and would have fallen somewhere out here. But you can see these companies are, let's see, Johnson & Johnson, what do we got here? Walmart, Procter & Gamble, Coke, Pepsi. And then out here, we could go a little bit further out here, we've got Lilly, another consumer staple. We've got Visa here. I threw a couple of, in fact, we've got American Express, which you can see was not a great performer. It lost over 80% of its value. So I threw a couple of financial stocks in here, but I wouldn't recommend doing that. Stick with the consumer staples. It'll be a lot safer, as you can see. And then what do we have here? We've got Microsoft. This is a high growth stock. We have Disney. This is a more safer consumer staple stock. You don't need to go to Disney, but they do pretty well. We've got Intel in here, which hasn't been that great of an investment, but at the time, you would have picked it. What else do we have? We've got Adobe here. We've got Amazon, and we've got Apple. Now, you can see this portfolio had a very nice return, 16%. And again, I'm using future knowledge, so some of that return is due to that. And it didn't have bad loss characteristics, 24.48%. Now, that is less than half the loss of the S&P 500, which lost 55%. So this portfolio is performing better in terms of return than the S&P 500. The S&P 500 had a 13% return. This one has 16%, and it had less than half the loss. Now you're going to say to me, oh yeah, Calvin, but you're a genius. You put Apple in there. You knew that stock did extremely well. All right, let's take Apple out and put it in cash, shall we? So if I take Apple out of the equation and I put the money in cash, so it's not invested in anything except maybe some T-bills, it did take a chunk off the return. I'm still beating the S&P 500, and the loss got even a little bit better. So this is not a bad portfolio. Oh, and what if I was not enough of a genius and I really shouldn't have invested in Amazon either? All right, let's take that off. Okay, now I just took the two best performing stocks out of here, put the money in cash where it doesn't have any opportunity to grow, and you can see I'm still getting a great return, and I'm still getting a maximum loss that's way better than the S&P 500. Now, for some people, this loss of 24, almost 25% is going to be too much. So how do we mitigate that? How do we make that better? Well, if instead of putting 60% of our assets in risk assets, let's only put 40% in risk assets. And as a result, I've also shifted away from government long bonds to what I call long to intermediate treasuries in the ETF IEF. These are 7 to 10 year duration. They're a little riskier, but they're leaning a little more toward the intermediate bond side. And you can see what happened. Our return went down, still very healthy, still not far off from the S&P 500, but our maximum loss went down a lot. This is a really good trade-off. You've got a 17, almost an 18% maximum loss and almost a 12% compound annual growth rate. And you can see the size of these bubbles got smaller because we're putting less in equities, and the size of this bubble got bigger. So this is a portfolio you could create and live with for many decades. Okay, so what if you say, hey Calvin, 18% loss, I've got $1 million, that's $180,000. I really can't tolerate that kind of loss. Well, you can make this even more conservative. So what if we put just 20% in risk? So we're going to really shrink that way down. And we're going to take a fair amount of money out of IEF and put it in treasuries, because this will further reduce the risk. So we're going to make IEF, let's say 20% of the portfolio. Wow, okay. So now we still have a fairly decent return here, over 6% compound annual growth rate. But now our maximum loss has gone down to 7.2%. This is a huge improvement if you want to have a very conservative portfolio where you're beating inflation and getting some reasonable returns, but you're not taking a lot of risk. And just for comparison, let's take a look at how the aggregate bond index did over the same time period. Now, aggregate bond index is totally bonds. There are no stocks in it, and it's considered very safe. Well, okay, I don't know if you can see this blood red orange dot here, but it's kind of blocked out by things. Let's see, yeah, there we go. Okay, so AGG, the aggregate bond index, had an 18% maximum loss, 18.43%, and a measly 4% compound annual growth rate. That is really awful. So you can do better with a portfolio like this, like I'm showing you here, manage it yourself, and get better returns than AGG and less than half the loss. This is phenomenal. As I said in my video, the ideal portfolio using just 2 ETFs or mutual funds, link below, creating portfolios that perform well isn't rocket science, and you can do it yourself with just 2 to 3 ETFs or mutual funds. But if you're willing to do the work to select high-quality individual stocks, the long-term rewards could be even higher. And remember, be a long-term investor and measure your progress in decades, not the most recent 1 year or 1 quarter performance. Until next time, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
really nice recording. It'll be a nice movie. I think so.
Running out, drying out, what did you say? What did you say when I told you? Maybe this wrist wasn't gold-proof. Packing my bags like it's all true. Hard to make friends when I'm focused on all these bars that I'm holding. I like the cold, but it's lonely, yeah. This life feels like the sunny water.